Welcome, curious minds, to the deep dive. Today we're digging into the latest from BigBear.ai, ticker BBAI, specifically their Q2 2025 results. Our mission, as always, is to cut through the noise, the corporate speak and just the raw numbers, and really get to the real story behind what happened. Earnings reports can be dense, right? But we're aiming to give you a clear, structured view. We'll use our usual framework to break it all down.
That's absolutely right. Because look, the official numbers are just one piece. You really have to understand them in context. What did the market expect? And that's key here. Our analysis pulls together the company's data and that real-time market data, so you get the full picture, not just the company line.
All right, let's jump right in. Now for slide 1, the at-a-glance scorecard. And wow, what a first impression. BigBear.ai's Q2 results, well, they significantly missed what Wall Street was looking for on both revenue and profitability. Let's get specific. Reported revenue was $32.5 million. That's a miss of nearly 21% compared to the consensus estimate, which was around $41.0 million. Big gap there. And profitability. The diluted loss per share came in at $2.71. That's a huge miss compared to the forecast, which was somewhere in the $6 to $7 range. So you can imagine the market reaction. The stock price, it dropped almost 30% in after-hours trading right after the announcement came out. Initial analyst takes really zeroed in on that dual disappointment, missing on both counts.
Yeah, a double whammy. And if you look year over year, the picture gets even more, well, dramatic. Let's pull up those numbers from the table. Total revenue actually went down. It was $39.8 million in Q2 of 24 and dropped to $32.5 million this quarter. That's an 18.4% decline.
Okay, down 18%. Not great, but...
Right, but here's the kicker. Net loss. It went from $14.4 million last year to $228.6 million this quarter. That is a staggering 1,483% increase in the loss.
Whoa.
Yeah. And diluted EPS followed suit, widening from $2.06 to $2.71. That's over a 1,000% increase in the per-share loss.
Okay, hold on. An 18.4% revenue drop, but the net loss widens by nearly 1,500%. That feels like a massive disconnect. How does that even happen?
That's the million-dollar question, or maybe the $200 million question here. And it really boils down to two main things you see in their statements. First, there were over $200 million in non-cash charges this quarter, huge ones. Things like goodwill impairment and changes in the value of derivative liabilities. These weren't really there last year, not at this scale anyway. They're accounting charges, technically unrelated to the day-to-day running of the business, but boy, did they impact that bottom line.
Okay, so accounting adjustments, not necessarily operational collapse driving that massive number. What was the second factor?
The second piece is share dilution. The weighted average number of diluted shares outstanding jumped by over 30% year over year, went from about 246 million to over 320 million shares. So that much, much larger net loss was spread across significantly more shares. This was mainly due to their capital raising activities.
And you mentioned diluted EPS specifically. Maybe quickly define that versus basic EPS for folks.
Sure. Basic EPS is simple. Net income divided by the common shares out there. Diluted EPS, which is what we're focusing on because it's more conservative, adds in the potential impact of things like stock options, warrants, convertible debt. Basically anything that could become common stock and dilute existing shareholders. For a company like BigBear.ai, with lots of these instruments, diluted EPS gives a much fuller picture of potential claims on earnings.
Got it. So the headline loss looks terrifying, but a lot of it is non-cash charges and share count changes, which brings us perfectly to our next section. Moving to slide 2, the engine of profitability. Let's peel back those big non-cash items. How did the actual operational efficiency hold up?
Well, even setting aside those massive charges, the operational side did show some deterioration. Gross margin, for instance. It compressed down to 25.0% this quarter, compared to 27.8% in Q2 last year.
Okay, and what does that usually signal?
It could be a few things. Maybe pricing pressure from competitors. Maybe they're taking on lower margin projects. Or it could just be some internal cost structure inefficiencies creeping in. Whatever the cause, that pressure, along with other operating costs, led to a much bigger operating loss. It ballooned to $90.3 million, up significantly from $16.7 million the year before.
90 million operating loss. And what was the single biggest piece driving that increase? Was it one of those non-cash items again?
Exactly. The largest driver was a $70.6 million non-cash goodwill impairment charge. And crucially, that's classified as an operating expense, so it hits the operating loss figure directly.
Right, goodwill impairment. That's basically writing down the value of a company they bought previously, saying it's not worth what they thought.
Precisely. It's an acknowledgement that an acquired business isn't expected to generate the cash flows they originally projected when they bought it. It definitely raises questions about their past M&A strategy and capital allocation. Were those good buys?
Yeah, important questions. So, okay, we have this huge gap net loss, heavily impacted by non-cash items. Management often uses adjusted EBITDA to show a core profitability picture. How does that look when you reconcile it?
Right, this is where we bridge that gap. And it's quite revealing. You start with that huge gap net loss, the $228.6 million. Then you add back the usual stuff. Interest, taxes, depreciation, amortization, or D&A. That was about $7.9 million. Then comes the big stuff. Add back that $70.6 million goodwill impairment we just discussed.
Okay.
And then add back an even bigger one, $135.8 million for the net increase in the fair value of derivatives. That's another major non-cash charge from marking financial instruments like warrants to their current market value.
So those two alone are over $200 million added back.
Exactly. Then you add back about $7.8 million for other adjustments, things like stock-based compensation, maybe some one-time restructuring costs. After all that adding back, you arrive at adjusted EBITDA management's preferred view of core operational profitability, and it comes out to a loss of $8.5 million.
Okay, so still a loss operationally, but negative $8.5 million is a world away from negative $228 million.
Absolutely. It highlights that the headline number was just dominated by those non-cash accounting charges. Adjusted EBITDA, while still negative, gives a much clearer sense of the underlying sort of cash burn from the core business this quarter.
All right, that makes sense. Next, we move to slide 3, financial strength and shareholder rewards. And this is where the story takes a really interesting turn, quite a contrast to the profit picture.
Yeah, the big headline here is a significant positive transformation on the balance sheet. BigBear.ai ended Q2 with a record cash and cash equivalents balance of $390.8 million.
It's a huge number for them, and this isn't just a random outcome. Boosting liquidity like this seems to be a very deliberate part of management strategy right now. So nearly $400 million in cash. What about the other side of the balance sheet? Liabilities, debt.
Well, they reported total liabilities around $332.8 million and total stockholders' equity of $266.6 million. That gives you a debt-to-equity ratio of roughly 1.25.
Yeah.
But maybe more importantly, with that much cash, they now have what you'd call a net positive cash position of almost $250 million, meaning their cash significantly exceeds their total debt. That provides tremendous financial flexibility and definitely reduces their risk profile.
Okay, let's unpack this. Given the operational losses we just talked about, where did almost $400 million in cash come from? It clearly wasn't generated by the business operations.
No, definitely not. This massive cash influx came almost entirely from financing activities.
Yep.
Specifically, they raised $293.4 million through an at-the-market or ATM offering.
Ah, the ATM offering. So selling shares directly into the market.
Exactly. They essentially capitalized on previous investor enthusiasm for AI stocks, selling shares when the price was higher to build up this substantial war chest, as they called it.
The war chest. Sounds like they have plans.
It seems so. Management framed it as serving a dual purpose. Defensively, it's a buffer against those ongoing operational losses, giving them a much longer runway. And offensively, it gives them the resources to pursue what they termed significant investments, both organically and inorganically. Acquisitions, internal development, things like that.
Okay, significant investments. War chest. Sounds ambitious. But given the recent operational miss and needing that ATM, is there significant execution risk here? Can they really deliver on these big opportunities they're hinting at?
That's the crux of it, isn't it? It sets up that high-risk, high-reward scenario we'll talk about in the takeaways.
And briefly on shareholder rewards, dividends, buybacks.
Nothing mentioned in the release. No dividend declared, no share repurchase program announced. Which is pretty standard, really, for a company in their position, unprofitable, focused on growth. They're prioritizing reinvesting every dollar back into the business right now.
Makes sense. Okay, that covers the balance sheet strength. Finally, let's look at slide 4, the road ahead management's outlook and key takeaways. This is where management tries to reset the narrative, right? Point towards the future. And they started by adjusting expectations downwards. New, lower full-year 2025 revenue guidance between $125 million and $140 million. That's a cut. And maybe more telling, they completely withdrew their adjusted EBITDA guidance for the full year. Didn't give a new number, just pulled it.
Yeah, withdrawing guidance is usually a pretty significant signal. The reason they cited was disruptions in federal contracts and uncertainty on certain Army programs. CEO Kevin McAleenan addressed this directly in his comments. He acknowledged those headwinds, saying they've seen disruptions in federal contracts, most notably in programs that support the U.S. Army. So, a clear admission of near-term pain points.
But they didn't dwell on that, did they?
No, not at all. He quickly pivoted to the future, highlighting tremendous opportunities, especially from what he called the one big beautiful bill that seems to refer to recent large government funding packages. He mentioned specific numbers: $170 billion in supplemental funding to the Department of Homeland Security and $150 billion to the Department of Defense. Huge potential pots of money they hope to tap into.
Okay, big government spending potential. Anything else?
Yes, also a big emphasis on global growth. He mentioned a new partnership in the UAE as being just the beginning of our international expansion, so looking beyond the U.S. federal market too.
And the CFO, Sean Ricker, connected this directly back to that cash pile, right?
He did. He reinforced the strategy, stating, and this is a direct quote, "Our record cash balance will enable us to make significant investments, both organically and inorganically, in an order of magnitude that was not possible before." Basically saying, we have the money now to make big moves.
Okay, so pulling it all together, what are the main takeaways for listeners trying to make sense of this rather contradictory quarter?
All right, let's summarize. I think there are 4 key takeaways from this deep dive. First, it was really a quarter of 2 conflicting stories. You had the severe operational misrevenue, earnings, guidance cut, signaling real near-term challenges. But then you had this massively strengthened balance sheet thanks to that capital raise. It was dilutive, yes, but maybe strategically necessary to provide a long runway. They basically bought time and flexibility with cash.
Okay, story 1, operational miss. Story 2, huge cash infusion. What's next?
Second takeaway. GAAP profitability was seriously obscured by those major non-cash charges. Remember that $228.6 million net loss? It was overwhelmingly driven by the goodwill write-down and the derivative value changes, not by collapse in day-to-day operational cash flow. Understanding the GAAP versus non-GAAP distinction is just crucial here.
Got it. Don't just look at the headline loss number.
Third, there's a very clear strategic pivot happening. Management is actively shifting the focus away from the current problems, like those Army contract disruptions. They want investors looking towards future, potentially much larger catalysts, those big government funding bills, international expansion, and that new cash hoard is positioned as the key enabler for this pivot. Forget today's problems. Look what we can do tomorrow with all this cash.
Makes sense. Shifting the narrative. And the final takeaway.
Finally, it all points to elevated risk and potential reward. That revenue miss, pulling guidance that screams near-term uncertainty and execution risk. Can they actually land those big new contracts? Can they integrate acquisitions well? But on the flip side, having that fortified balance sheet and aligning themselves with major government spending priorities, well, it creates a classic high-risk, high-potential reward situation. Big challenges, but also potentially big payoffs if they execute well.
So if we had to offer a final narrative on BigBear.ai's Q2, what would it be? I'd say it's a complex story. A company navigating a really difficult but maybe strategically necessary transition. The operational miss was sharp, no doubt, forcing them to reset expectations. But they strategically counterbalanced that setback with a very successful, very large capital raise. It transformed their financial position from maybe a bit precarious to one of strength.
Yeah, and now management is using that financial firepower, that war chest, to pivot the whole story. They're essentially asking investors to look past the current turbulence, the Army contract issues, and focus on these potentially transformative large-scale opportunities ahead, funded by this new cash.
So this quarter feels like a real inflection point. Near-term operational pain met with a long-term strategic vision, now fully funded. The question is, can they execute on that vision? Okay, before we wrap up, just our standard reminder. This deep dive was purely for informational purposes. It is absolutely not financial, investment, legal, or tax advice. Any investment decisions you make should always be based on your own thorough research and ideally in consultation with a qualified financial professional who understands your specific situation.
And we also need to add the AI disclaimer. This report, this analysis, was generated with the assistance of an artificial intelligence model. It integrated data from the official earnings press release and publicly available market data. While every effort is made to ensure accuracy, errors, or omissions can sometimes occur. So please, always independently verify any information before relying on it.
Like and subscribe to stockanalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.